Thanks very much, Saul. That was really interesting. Our next speaker is Omri Thomas from ABAX Investments. Omri will be presenting on the Nedgroup Investments Opportunity Fund, which utilizes a broad toolkit of asset classes and strategies in order to deliver on its inflation-beating performance objective. They also aim to protect capital over rolling 2-year periods. Omri, welcome, and please go ahead.
Thanks so much, Anil. And as always, we'd like to give you a quarterly update on the fund, on how the fund's positioned, how it's performed, just the contributors to return and what the market looks like at the moment and how the fund is positioned for that outlook. So just reflecting on the year-to-date performance, you would have seen that the fund had a fantastic start to the year. We've delivered 16.6% year-to-date compared to the benchmark of CPI plus 5 of 6.8% and peers of 11%. And over all measurement periods, we're very pleased with the fund performance. What's contributed to performance? You would have seen that on the equity side, both local and foreign equities actually contributed nicely. And also our domestic bond position at long last started delivering returns. So we were very well positioned for the GNU. We had a high weighting in bonds, we had a long duration. Within the local equities, we had a lot of domestic equity exposure, so that were beneficiaries of the new government. And then we also had some Chinese equity exposures that you'll know from previous presentations have hurt us, but more recently that's contributed to performance. And that's pulled up our 12-month performance to a return of 21%. For over the last 12 months. So very pleased with performance, despite what we believe has been quite a conservative positioning. So without taking on too much risk, we've been able to deliver pleasing returns. But if you look at the markets at the moment, we've had a tremendous run in markets. And the markets are way above their long-term averages. Whether you look at equities, property, bonds, the only asset class that's below its 5-year and 10-year average is global bonds, and that's because it's come from such a low yield level, and it's just normalized. So at current levels, probably a better starting level, but other asset classes had really had a phenomenal run, and we'll sort of unpack that and see what the current opportunities are within there. So if we look at South Africa, we see the SA risk premium have gone from over 5% down to 3.5%, which is back to the levels that it was pre-COVID. So a lot of positive sentiment towards South Africa, and rightly so. We are starting to see positive developments where one looks at load shedding, which hasn't happened for a long time. And if you look at some of the government portfolios that at long last starting to deliver on some of the mandates. So positive momentum, positive sentiment from foreign investors, and it looks like our SA GDP growth also starting to look better and some improvements there. But I mean, if you look at the SA equity market with this rally relative to what we see as an implied fair value PE, now more than one standard deviation overvalued. But as you know, our market is sort of almost a tale of two cities with commodities. When they look expensive, that's the time when you want to buy it. And our domestic shares having come from a very low valuation level, and despite the run, still offering decent value. So despite the index at an overall level looking expensive, we are still managing to find decent value, but we have taken the opportunity to, into this run, reduce our equity exposure slightly. If we look at bonds, you can just see how the whole yield curve has shifted down. So whether you were in the 2030s or the 2040s, long duration bonds, we've seen a significant rally in bonds. More recently, we've seen a bit of a sell-off, and we used that strength to 2 weeks ago significantly reduce our bond holding. We shifted some of that into inflation linkers, and we also reduced the overall duration of our bond portfolio. If we look at the US market, we've seen a tremendous run in the US equity market. I think over the last year, US equities in dollars up close to 30%, so a phenomenal performance. And that's on the back of a good period, the prior 12 months. And you've seen US Treasury yields normalizing. So at current level, not much to choose between the two. So there's no little equity risk premium priced into equity. So we actually think the US equity market looking expensive. And the last time we were at these levels was sort of almost at the dot-com boom time, dot-com bust time. And so we just sort of say, be cautious, don't get sucked in right at the top of the market. We've more recently seen volatility index, which is a measure of what you pay for getting protection, also moving up. We used that period earlier in the year to buy some protection, but it's actually just been a cost because the US market has just kept on running, but protection not as cheap as it was earlier this year. So where are the opportunities in the current market? Well, we think US inflation linkers, the TIPS, from a negative real return of 1%, now offering a 2% real return. So it's gone from an uninvestable asset class to an investable asset class. So we find value there. We've also continued to like the Chinese equity market, despite this recent rally, still trading at levels that 90, 95% in some cases below their all-time highs. So when you look at a share like Auto Home, it was trading at below the cash on its balance sheet. So some very attractive opportunities in China, and we continue to hold the faith there. One has to, with China, always take the left field risk of regulatory changes into account. And so you manage that risk through portfolio construction. So despite our optimism about the market, we restrict what our total exposure can be. So, and because of that, we've taken some profits on some of these shares that have run hard. So some of the local opportunities, and I've used ABSA here as an example. It's true for most financial services companies, and you can see over time the red line, our dividends have grown. There was a big dip in 2020 around COVID, but if you look at the long-term trend, it's been growing. And we're still forecasting that to grow sort of mid to high single digits over the next 3 years. Now, because of that volatility, we've been able to structure a very attractive investment notes. So one of the notes that we've done is one where the strike is at 155 Rand, that red line, and it's a 3-year note. And if every 6 months you make an observation, if the share is above the starting level of that 155, you get paid out your coupon. And the annualized yield on that structure is 30%. So very attractive opportunities within structuring again and within some of our local shares. So it's the highest weighting we've had to hybrids and structured notes for a very long time. We also continue to find value in the mid-cap and small-cap space. As you know, we also manage the Nedgroup Entrepreneur Fund, which has delivered 35% over the last 12 months. But you can see just a close correlation to GDP over time. And we expect GDP to start improving, which bodes well for the small and mid-caps. And despite this run, they've come from very low valuation levels, and it's trading at more reasonable levels, but still at cheap levels. It's not a very liquid sector. If the foreigners start to try and buy our mid-caps, that could result in a further push in those shares. If we look at our bonds, as I've said, we've had a rally where our fair value is not too far off where the bonds are trading at the moment. So, but we think there's a structural shift in the country risk premium. And you could see as the global yield curve shift down, that we see another leg in our local bonds. So you're still getting a decent real return from our bonds, but a lot of the juice has been taken out, and that's why we've just taken some profits, but still a decent exposure. Okay, just looking at the different asset classes and valuations. As I said, I think we continue to see value in China and also emerging markets. We think US cash has gone from the expensive bucket into the attractive bucket, offering a very good risk-adjusted return, as well as US bonds, an uninvestable asset class, which now actually offers a very attractive yield. SA equity is probably on the expensive side, but we still find value in some areas. Developed market equities outside the US, we still see as fair. SA bonds have moved from attractive into the fair bucket, and the rand we also see as fair at the moment. In the expensive bucket, developed market bonds, US equities, and volatility, which is used for the pricing of options. So looking at the fund positioning, you'll see that we've increased our cash levels. We've reduced our bonds and shifted some of that into inflation-linked bonds. We've slightly cut our equity exposure, both on the local and the foreign side, but still 50% exposure there. Within that, some of that is our structured notes, so there is some embedded protection in there. And then we've just highlighted our top 10 exposure. What's interesting, you'll see that 4 out of our top 10 positions have got exposure to China, which we're still fairly positive on. And then some of the domestic beneficiaries, as well as small and mid caps. Thanks very much.